Stop losses is one of the main factors that messes with the trader's mentality while in the trade or before entering the trade. So let's break it down on what's the process of adding a stop loss or moving a stop loss. First, you have to define risk. First, before talking about stop losses, we need to identify what kind of risk you can handle, or the plan you have prepared before trading. How much risk I can handle on each trade, how much risk I can carry on the trading day. After defining those, you have to know, and the patience factor comes in once you sit in front of the market with that risk, because if you're not patient, you start shooting for every candle that goes up or down in your chart. So once you define your risk, you know your strategy, you know what you need to do, it's now a matter of patience. Don't get triggered by any unplanned factor that comes on your way in the market. So defining risk based on your plan, based on your risk appetite, and then comes patience. So once we have those in place, where should I put my stop losses? Where should I put my stop loss? And every other trader answer this question based on their understanding or based on what they want in the market, but let's here follow the logic. So some of us put their stop losses based on fixed number of ticks. Imagine now a trader comes in every entry in the market because let's say, for example, I don't want to lose more than $30 in any given trade. So they come in every situation. In every situation, do you want a long or short? They come with fixed, let's say, 6 ticks on every setup because they don't want to lose them more than $30 or more than 6 ticks. That's you trying to apply what you want on the market. It's not the other way around. You have to understand what kind of market situation you're in, what setup you're looking at, and then be flexible to adjust that stop loss. And then if it doesn't suit your risk, you refrain from taking it. But coming to the market trying to impose your fixed risk on the market, trust me, in most cases the market will take it. The market is happy to take such behavior and liquidity in the market, because you want your risk fixed, yes, but the market range, if you don't respect the market range or the setup you're playing in, if you don't respect that the market can move up or down in a specific range, your stop will be taking most of the time. So it's wrong over here to think that I should fix my ticks on every setup. You gotta be flexible, and if you see the range is not allowing that kind of risk you want to take, you should refrain from taking it. Some other traders, they put the stop based on the setup failure, and this is what you should do. You should identify the setup first in front of you. You should identify the entry and exit on this setup, and then see if that setup is suitable for your risk or no. So in this case, you have one of two things you can do. If the setup in your favor and within your risk parameter, you can take it. If the setup not within your risk parameter, there's two things to do. Whether avoid the trade, even though it's a good setup for you and it tells you a lot about the market direction, but it doesn't suit your risk that you planned. So the first thing you can do is to avoid the setup. The second thing is to reduce size. Reduce your size. If you reduce your size on that given trade, you can actually handle the swing of your range. You can put your stop loss in the right place, and therefore the low size will give you the planned risk earlier. You cannot go aggressive in such setup. Let's move on. Based on my risk limit, so you're entering the setup and you're putting, let's say you planned a risk on the trade or on the full day. Let's say you planned a full day risk is a $200. and then comes a setup that you like. You think that you know the market direction in a certain range, and you enter the trade, and you put your stop loss based on your risk limit on the day, which is the $200. That's wrong. If you enter any given trade without identifying where is your entry, where is your exit if you're wrong, where is your take profit prices, if you're missing any of these elements in any given trade, stay away. This will turn out to be emotional trade. It will turn out to be exhausting in most cases, and unnecessary wasting risk. Should I put my stop loss based on my time frame? Yes, you have to understand and you have to identify which time frame you're playing. Are you playing on a minute or a seconds frame? Are you scalper? Are you taking this trade based on a 5 minute or 15 minutes trade? That means that this trade will require bigger risk. It will require more hours on the market, and it will require probably more effort. So if that big frame risk doesn't suit you, don't try to anticipate big time frame setups with a tight risk like you're trading the 1 minute. You have to marry those ideas within your time frame. So one of the biggest mistake traders do, they want to take a big time frame setup, that's something that might take hours during the day, and they tend to have a small risk that it's really not suitable for that time frame. A very tight risk on that big frame setup in hope that the market will move from their point. So you have to respect your time frame, and again, as I said, if this setup is not suitable for your risk, so stay away. You can get, that's what I do actually, and this is where your experience come, your exposure to the market and screen time. You can actually trade big time frame on tight risk, but if you are really patient to wait for the perfect entry, the closest you can take close to your where you're wrong. So for example here, let's have an example. This is, let's say, the 15-minute time frame, and we have a setup, for example, like H3 setup, and we're waiting for this third head to go to our value. That's my trade in short. So when the market is playing a big time frame and the market already down here, on a big time frame 15 minutes, that's maybe 3 times or 4 times more than the usual risk you want to take. If you have missed the setup entry over here and the market ran away from you, then you have to be patient. You gotta tell yourself, I cannot jump in here because it's a big risk. I know I'm right on the direction down, but the risk I'm taking here is so big that if the market decide to play in this range, it will turn my execution to emotional execution. So the right thing to do here is to skip the trade or wait for the market to come back up as close as it could to my area where I'm wrong. The closer to the market comes to the area where you're wrong, that should not make you emotional and avoid the trade. That should make you prepared and ready to take an entry close to where you're wrong to reduce your risk. And based on that action, your profit range will increase. Yes, you might get some of those losses, but when these setups run, the risk reward will pay it off. So don't put your stop pick based on a fixed ticks. Try always to identify the setup in front of you. If the setup failed, that means you're wrong, and this is the right place to get your stop loss in place based on my risk limit. Of course not, you have to identify where the setup is wrong, not based on how much you put money on the day, and also based on your time frame. You have to consider these elements. Once we get sorted with that, once we have an idea around yes, okay, now I learn that to be patient, now I learn where to put my stop loss, now I learn that number of ticks is just my forcing my will on the market, it's no more than that, so I should not do these things. Now we have an idea where we should put our stop losses. But now comes the bigger aspect of stop losses that affect your trading, moving the stop loss. So when the market is moving in your favor, for example, short going towards target, moving a stop loss becomes another challenge. Should I trail my stop loss? Like automatic trail that you can find on most platforms. So you take your entry, and if the market moves 10 ticks, your stop loss will move 5 ticks. Every 10 ticks market moves, this is the automatic trail of stop loss. Every 10 ticks the market move in your favor, the stop loss will move 5 ticks automatically. That's a trail. Or you can do it manually. Or lock my entry. So once the market moves in my favor, gives me some space, so I bring my stop loss, I bring it and I lock my entry. I mean setting your stop loss in front of your entry, so if the market decide to go back, it will take you out and you will not lose any money. That's what I mean by locking your entry, that you put your stop loss ahead of your entry. If the market reverses, you don't lose any money. And the third one, based on the market behavior. Let's look at these three things. If you move your stop loss based on an automatic trail, that's amateur and a very, very poor way to execute with your stop loss. Why? Because every time you trail your stop loss, let's talk about the logic in this area. Let's talk about the logic here. I took an entry where I believe this is the best area I can let's talk about short. This is the best area I can short this market. So I decided already that this is the best price I can short this product towards my target. And you set your stop loss. That means this stop loss means this is where I'm wrong. If the market hits my stop loss, I'm wrong. All right. What does that mean? That means you already accepted from this point, between this point and your profit target, you accepted already by defining those that the market has a free range to play within these price limits. You already allowed that and you already accepted that. So trailing your stop loss behind the price movement, trust me, you will be giving almost more than 50% of your profit. You're leaving a lot of money on the table on every trade if you decide to trail your stop loss. By trailing your stop loss from here to here, market goes back and takes you out and then ranges and go back to your target, and you end up missing half of your profit on each trade. That's the problem with the trade. So don't even think about this is a helpful way to protect your risk. No, you're wasting a lot of money, leaving a lot of money on the table. Locking the entry is actually the same idea of having a trail stop. Why? Because once the market moves in your favor, as I explained already, market moves in your favor and you lock your entry, you move your stop loss ahead of your entry. Of course, we have reasons when we're doing that. If you're trading in volatility, if you can lead the dome or the ladder, like we spoke earlier in the strategies course, if you have a reason like extreme volatility during that and you have a plan to do that within a specific market behavior, that's fine. But just looking the entry on every trade, guess what? Same like the trade. The market will come back and guess what? You decided that this is the best short for this market at this price. Why would you want to exit at this price? You decided this is the best entry. Why? What makes you rethink that that was my best entry and this is my best exit? Think about it. So locking your entry is just taking the effort of thinking about the trade and planning it, and then the market just ranges around it, takes you out, and then you out with zero. You will be so happy if the market goes to your stop loss, but guess what? In the cases that the market makes your profit target, you will lose it as well. You're trying to avoid risk, and this is not how markets operate. Don't try to avoid risk. Take the setups, take the losers and winners, and let the ratio between the risk reward pay out. By this, you're interrupting the process and you're trying to mess with the whole plan and the whole strategy you're playing within the market. So trail and lock entry is only for amateurs. Once you understand how markets operate, once you understand how to make money in markets, you will stop doing those. But now you have some information, try to avoid them early. So how should I trail my stop if I want? Based on market behavior. The market on the way between, let's say double tops, T2 setup towards target. I have multiple targets down based on the market behavior. Let's say I took a short over here, put my stop loss. Based on the market behavior on the way, I can move my stop loss. If the market says there is a strong, for example, just random example, we have a strong support over here and the market start to reject, showing signs of dry value, and I see my target originally was this price, and the market now showing me that this value is holding the market and now is showing sign of rejection. That means that it's showing that it is a dry liquidity and market to start to reverse back up, seeking higher liquidity. This is where I should exit and move my stop loss and exit the trade. Now something standing in the way of my execution and profit target, and it's showing me clearly that the market has no intention on continue towards that target, so I should exit. This is active profit management. You have to be aware of the market doing, so you cannot actually leave the screen and let things play out. You have to sit and watch. If the market says otherwise on the way, be quick to react and exit. So based on market behavior, you should move your stop loss, and always I recommend sizing on the way and taking profit on the way. Always have a plan how to take your profit on the way. For our strategy, for example, we take profit at HVN points at the volume profile, or we take at any value area on the way. If my target is at as a certain price and we have couple of values on the way, make sure you have enough size on this trade to scale out and take profit on the way. Make sure you pay yourself on the way. Why? In the way of your trade, that's better psychologically, better for managing risk, and also to improve your expectancy. A lot of things you can do by taking profit on the way to your target, but just don't do it randomly. Do it based on what the market says to you. You have to have a proper structure in each range. You have to know execution what you're already going to do in the case A, B, or C. Screen time and more execution in the market will give you more experience to interact successfully. It takes some practice, but these just a heads up for you to see the market the right way.